There is a bank in Switzerland whose name almost never appears in headlines, yet its quiet decisions ripple through every mortgage, every interest rate, every economic crisis you will face. Behind closed doors in Basel, the Bank for International Settlements connects the world's 63 most powerful central banks, writing the hidden rules that shape money itself. Most people have never heard of it, but when this secret institution acts, nations obey. Why did the world's governments give so much power to a single unelected body? And what are the real consequences for your daily life? To answer that, we have to go inside the institution that quietly runs the world. In 1930, as Europe struggled with the aftermath of World War I, the world's leading central bankers gathered in The Hague to sign the charter of a new institution, the Bank for International Settlements. Its original mission was both technical and ambitious. It was to manage the tangled web of German reparations under the Young Plan and to create a permanent platform for central banks to cooperate beyond politics. Basel, Switzerland, was chosen for its neutrality and discretion. The Bank for International Settlements was structured as a private company under Swiss law, with an international treaty granting sweeping legal privileges. Its premises were inviolable, its records shielded, its staff protected from local courts. 63 central banks now own the Bank for International Settlements, representing economies that account for most of the planet's financial flows. Mark Flandreau, a leading historian of global finance, has traced how figures like Montague Norman, the powerful governor of the Bank of England, and Gates Magera, the American who became the first chairman of the Bank for International Settlements, designed the bank as an elite, insulated forum. Their aim was to shield monetary cooperation from short-term politics and parliamentary scrutiny. Early tasks ranged from collecting German payments to acting as trustee for international loans. The real innovation was its autonomy. It answered to its member central banks, not to any government, and operated with a level of secrecy and independence that was and remains unusual among international organizations. The founding documents held in its Basel headquarters set out a mission that has hardly changed. That mission is to foster international monetary and financial cooperation and to serve as the bank for central banks. Over the decades, this mandate allowed the Bank for International Settlements to evolve from a reparations clearinghouse into the quiet center of the world's financial architecture, operating far from public view, yet shaping the rules that govern global money. Inside the Bank for International Settlements, real power flows through committees whose decisions ripple across the world's banking systems. The Basel Committee on Banking Supervision, known as BCBS, meets behind closed doors in Basel, bringing together central bankers and regulators from major economies. While its standards are not legally binding, the rules crafted here, like those in the Basel III framework, shape the daily operations of banks from New York to Tokyo. Basel III is best known for raising the bar on what banks must hold in reserve. The minimum common equity Tier 1 capital ratio was set at 4.5% of risk-weighted assets, up from lower thresholds in previous frameworks. Banks must also maintain a Tier 1 capital ratio of at least 6% and a total capital ratio of 8%. On top of these, the capital conservation buffer adds another 2.5%, and the largest banks face even higher surcharges. These requirements are not just numbers on a page. They determine how much banks can lend, how exposed they are to shocks, and how quickly they must react when markets turn volatile. Basel III introduced new global standards for liquidity. The liquidity coverage ratio forces banks to hold enough high-quality liquid assets to survive a month of market stress. The net stable funding ratio pushes banks to rely more on stable, long-term funding. These rules, debated and refined in Basel's committee rooms, become national regulations through a process of translation and adaptation. Market pressure, peer reviews, and the threat of higher borrowing costs make it difficult for any major country to ignore them. Claudio Borio and William R. White, two of the BIS's most respected economists, have spent years analyzing how credit booms and hidden leverage can threaten stability. Their research helped shape the macroprudential approach behind Basel III, focusing not just on individual banks, but on systemic risk. What begins as a technical discussion among experts in Basel soon dictates the limits of risk for banks worldwide, with consequences for mortgages, business loans, and the broader economy. Behind the closed doors of the Bank for International Settlements, a different kind of power grid connects the world's financial capitals. At the center of that grid are central bank swap lines, reciprocal agreements that allow select central banks to exchange currencies, often in vast sums and at short notice. These arrangements act as financial lifelines during market turmoil, letting one country's central bank borrow dollars or euros from another and pass those funds on to domestic banks when private markets dry up. Most people never hear about these deals, but their design shapes the fate of entire economies. Access is not universal. The core network, sometimes called C6, includes the Federal Reserve, European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, and Bank of Canada. These partners hold standing, uncapped swap lines, meaning they can draw unlimited funds from each other, subject only to operational limits. Outside this inner circle, other central banks may receive temporary capped lines during a crisis, but their access is neither automatic nor guaranteed. Hyun-Song Shin, the BIS chief economist, describes these swap lines as the hidden plumbing of global finance. The mechanism is precise. A central bank deposits its own currency in a partner's account, receives dollars or euros in return, and then auctions those funds to local banks. At maturity, the currencies are swapped back at a preset rate. This system neutralizes exchange rate risk and keeps the flow strictly between central banks, away from political oversight or public debate. The result is a two-tier world. Major economies with standing swap lines enjoy a permanent safety net, able to tap foreign currency at will. Others watch from the sidelines, dependent on their own reserves or outside help. The criteria for entry into the club remain opaque, decided in confidential meetings among central bankers and reinforced by the routines of the BIS. In moments of stress, this unseen hierarchy decides who gets rescued first and who must weather the storm alone. In September 2008, global credit markets froze. Banks across Europe and Asia, loaded with US dollar debts, suddenly found their funding channels cut off. The cost of borrowing dollars soared, measured by the LIBOR-OIS spread, which exploded from just a handful of basis points to over 350. Panic moved swiftly across continents, threatening not just Wall Street, but factories, exporters, and workers far from the trading floors. Inside the Federal Reserve, Chairman Ben Bernanke and New York Fed President Timothy Geithner faced a problem that no domestic tool could solve. Foreign banks needed dollars fast. The solution came in the form of central bank swap lines, coordinated through urgent calls and confidential meetings that often included the BIS in Basel. At first, these swap lines were capped. As the crisis intensified, the caps were raised repeatedly, but it was not enough. On October 13, 2008, the Fed announced that for a select group of major central banks, including the European Central Bank, the Bank of England, the Bank of Japan, and the Swiss National Bank, there would be no limits. Any amount of dollars, as long as they had collateral. The spigot was open. Within days, hundreds of billions of dollars flowed out through these swap lines. The European Central Bank and the Bank of Japan alone drew over $300 billion at the peak. As these funds reached foreign banks, the worst funding pressures began to ease. The LIBOR-OIS spread, the barometer of panic, started to retreat, but the relief was not felt evenly. Only countries whose central banks had access to these uncapped lines could pass the dollars on to their banks. Elsewhere, firms faced credit shortages and layoffs as dollar funding dried up. For workers and businesses plugged into the network, the blow was softened. Lending contracted, but not as sharply. In markets left outside, the downturn bit deeper. The decisions made in Basel meeting rooms and New York conference calls quietly shaped who got rescued and who faced the storm alone. Agustin Carstens, the former head of Mexico's central bank and now general manager of the Bank for International Settlements, is the public face of a new era in global finance. Under his leadership, the Bank for International Settlements Innovation Hub has launched a series of pilot projects that push the boundaries of what central banks can do with digital money. Project mBridge brought together central banks from China, Hong Kong, Thailand, and the United Arab Emirates to test a shared digital ledger for cross-border payments using multiple central bank digital currencies. The pilot concluded in 2023 with real transactions settled on a common platform, faster and cheaper, and operating outside commercial banking rails. Another initiative, Project Icebreaker linked retail central bank digital currency systems across Israel, Norway, and Sweden, showing that separate national systems could connect through a hub to move money instantly between countries. These experiments are not just technical showcases. They point to a future where the Bank for International Settlements sits at the center of a digital monetary network, quietly setting the standards for how money moves across borders. The privileges granted to the Bank for International Settlements are unlike those of any ordinary financial institution. Its headquarters in Basel cannot be searched or seized. Its records are shielded from courts, and its staff enjoy legal immunity while carrying out official duties. These protections were designed to keep the bank free from political interference, but they also place it beyond the reach of democratic oversight. Paul Tucker, a former deputy governor at the Bank of England, has warned that committees meeting inside the Bank for International Settlements now wield power that shapes the rules for mortgages, business credit, and even the jobs available in every member country. The technical standards set in Basel become the backbone of national regulations, determining how much banks can lend and at what price. For households, this means that decisions taken in a closed room in Switzerland can ripple outward, affecting the interest on a home loan or the security of a paycheck, without a single vote cast or public debate held. While the Bank for International Settlements operates out of sight, its decisions shape the core of global finance. Those decisions happen without public elections and with little public scrutiny. As digital currencies and new crises emerge, the real architecture of power remains hidden. The future of money is being built quietly, not in public view.